One top strategist thinks the negativity in the markets is way overdone. Let's bring in Tom Lee of Fundstrat Global Advisors. Tom is one of the street's biggest bulls. He predicts the S&P 500 will be 12% higher by year's end, and he joins us tonight on the Fast Line. Tom, great to have you with us.
Thanks for having me here.
Why does Wall Street have it so wrong right now?
Well, you know, I think there's a lot of skepticism, and I think there's a lot of things to be worried about. But if we look back at the last 35 years or 50 years, you know, the equity markets typically take their direction from what's going on in credit, and especially in high yield. There's a lot of bullish developments in the high yield market. I mean, high yield's on track to be up 12% this year. The S&P's never had a down year when high yield's had a double-digit year.
Okay, so in this environment, Tom, what are the big stories, the big sectors that investors are really getting wrong, really discounting?
Yeah, well, I think there's two big storylines this year, and I think a lot of you guys were talking about it. The first is that, you know, the dollar hasn't been as strong as people thought, and it's triggering a pretty big rotation, you know, because there's positive revisions in the multinationals, and there's this global search for carry. I think it's really playing out most strongly in the energy, materials, and industrial space. You know, there have been huge moves in credit rallies. You know, the basic materials CDS contracts are back to 2012 levels, yet the stocks are at 2015 lows or close to the 2015 lows. Oil is up $9 from the strip where it was in December, yet earnings revisions in energy have been flat. We put a note up to just the four integrateds in the S&P may have $25 billion of upside to earnings this year from just the $9 move in oil. That's $2.60 per S&P share.
Hey, Tom. Tom, it's Brian Kelly. So I'm curious. HYG, we saw tremendous outflows this week. LQD had a terrible week. We're seeing big amounts of bonds coming to the market, a bond binge, if you will. If those rates go higher, does that turn you bearish?
Yeah, it might. But, you know, one thing you have to keep in mind just in the bigger picture, there's a global search for carry going on. You know, the net supply of U.S. corporate and government bonds this year is exactly zero. There's $1.1 trillion of bonds being issued this year, but there's $1.1 trillion in interest being paid. There's no new supply on a net basis, yet money's coming in from Asia and Europe. That's going to keep driving spreads lower. You know, you might have 1 or 2 weeks where these are widening, but I think the trend is for credit spreads to tighten.
All right, Tom, we're going to leave it there. Thank you for phoning in. Tom Lee of Fundstrat. I know you agree with Tom.
Well, yeah, I do agree to some extent. Look, I think it's a little bit scary right now because you look at put call, you look at the expiration we just had, you look at what funds are doing. Funds are rolling their protection. I mean, there's funds rolling protection. There's a little nervousness out there. There's no doubt about it. But upside calls are incredibly cheap right now, which tells you something. It tells you that this market, nobody's anticipating for a real runaway to the upside. So it scares me from the perspective that we could drift higher, and we will probably drift a little higher because everybody gets the timing wrong simply for that fact, because nobody expects the market to really move to the upside. If we do move significantly higher, I think it's a market to sell.
You had BK just talk about high yield. You know, we had those wonky options guys on this show with Dan Nathan character sat next to me. But he was,
I don't
you know
like
him,
him.
like good looking guy. They have a show in about, I don't know, what was it, about 19 minutes. And at any rate, he outlined an HYG put trade that somebody had put on, extraordinarily bearish. And I got to tell you something. What Mike and CBW and Dan have been talking about has all come to fruition. We'll see if they're right in HYG.
Well, what's happening, though, you can make an argument that you're seeing actually the credit conditions get to a place where we're talking about a Fed hike in the last couple of days. And suddenly, again, we went from a 4% probability of a Fed hike in June to now almost 30 in the last couple of days. So people clearly feel better about what will happen when the Fed starts to hike. And high yield before, 2 or 3 months ago, if the Fed was hiking into that, you had everybody pointing out, including our friend from Bank of America, Michael, who said that, you know, we've never seen the Fed hiking with spreads 600 basis points over. And now actually things have come in. China has stabilized. Credit has stabilized. Energy has been a self-feeding element for both the banks and the rest of the market. That is possibly very real.